Can you use cheap corporate dollars to put into an infinite banking policy, and should you? What are the pros? What are the cons? We're going to learn all about it today. Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me today is Christina Wyatt, wealth coach at Control and Compound. Hi, Christina. How are you?
Hey, Darren. I'm doing great. How are you doing?
I'm doing wonderful. This is a topic people have been asking about forever, so thanks for the feedback, listeners. And yeah, before we jump into it, Christina?
Yep. As always, I just want to remind everyone, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you're watching or listening on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on our socials at Control and Compound on TikTok and Instagram.
All right. So before we get started, too, I want to say, Christina, we both have lots of letters after our name. But we are not accountants and we are not tax lawyers. So we're going to talk in big picture, kind of educational stuff. But this is not tax advice, and it's not not legal advice. So get your own representation. So where do we get start, Christina? Let's talk about taxes.
Yeah, I think that's exactly where we should start, because that is business owners' worst friend or worst enemy. So we'll talk about taxes and the difference between getting taxed personally and business. So I think if we break that down, then we can talk about, the problems and the solutions and how we can get that fixed up.
Yeah, so what we're going to talk about is CCPC, Canadian Controlled Private Corporations. So those are operating businesses in Canada, and specifically we're going to talk about the first $500,000 of income. So let's say you have a corporation and you earn $1 into it. And again, we're going to assume the people with these corporations are, making money personally, corporately, and have some money. So they're in a mid to high tax bracket, just for our illustration purposes. But roughly speaking, you earn $1 in your corporation and you go, okay, great, I want to pay that out to myself in the form of a salary. Well, you're going to take that dollar, pay it out, and you're going to pay somewhere, ballpark 50% tax on that, maybe 40 to 50%, depending upon your how much other income you have, but ballpark 50 cents. So business owners go, wow, well, what if I left that dollar inside my corporation? Well, if you leave that dollar inside your corporation, you're going to pay that small business tax of 10, 11, 12%, depending upon your province. So you're left with 88 cents. So if you think of that, you earn $1 in your corp, you leave it in your corp, you pay, let's say, 12% tax, you're left with 88 cents. Or you earn $1 in your corp, you pay it to yourself, and you're left with 50 cents. 88 cents, Christina, I think is more than 50. So that's why people love to invest inside their corporation.
Yeah. As business owners, we love using those 88-cent dollars. They're our favorite, right? So the first thing we want to do is, where can we use it? Where can we, what can we do with our 88-cent dollars? That's when we look at investing, right? So people will immediately say, okay, so instead of taking it out to invest, pull that 50 cents out to go put in an RSP and that doesn't sound right. Like, as a business owner, absolutely that is not a good idea. You need that money for your business and whatnot. So the first thing you're going to think of is, okay, well, where can I invest inside of a corporation? And you can invest in lots of things inside of your corporation, right? You can do GICs, you can invest in the stock market, but there's some pitfalls to that, which is what we're going to talk about, right? One of the biggest ones is tax on your growth. So there's no such thing as a tax-free savings account inside your corporation, right? You're investing in the market, GIC, those types of things. You're going to pay full tax on that growth inside of the corporation, which is, that can be quite a bit of tax when you're looking at your returns. Half of that's getting eaten up by tax. That doesn't sound as, as nice as we want it to be. So you've got that. Along with that, when you're investing in a corporation, the growth that you have there is passive income. Passive income can impact our small business tax deduction, so that, in order to get those 88-cent dollars, we use the small business tax deduction. If we go over 50,000 in passive income, and again, not an accountant, talk to your accountant, but 50,000 in passive income, you're going to start seeing a reduction in your small business tax deduction. And if you hit 150,000, that's going to eliminate it. Like, passive income, that can add up pretty quick. You do a couple private lends, things like that. You put in the stock market. GICs are giving 5% now. You that can add up. 150,000, you can, and you have to be aware of that. And a lot of people think maybe if it's it's in my HoldCo, it's not going to impact my operating company. It does. Those two are tied together. They're going to look at that as one, and that passive income is going to impact it for you. So that's a pretty big pitfall when you're investing.
That's huge, Christina, because when they first came out with these passive income rules, and no one likes them, I think they're horrible. But the idea was, okay, well, you could have $1.5 million in your corporation, let's say invested at 2 or 3%, which was the going rate. So most people aren't going to hit that $50,000 of passive income. But now with interest rates, increasing, and then a lot of our clients do in private lending. I mean, you take 300,000, you do a private lend at 15, 16%, you're pretty much at your 50 grand already, and you go over that, that's really gonna affect your OpCo. So that's huge. And the other thing I just add on the tax is business owners typically, the money they have inside their corporations, it's money they think they're going to need at some point, right?
Yep.
Even if you get 100, 200, 300 grand in there, you're like, all right, well, next quarter is going to be slow, or this is our busy season for expenses, or we're going to grow this or expand this, or we need money at some point. So that money typically stays in interest-bearing certificates, like a bank account earning nothing, cashable GIC or a bond or something. So that's that fully taxed 50+% tax rate on that growth inside the policy. So that's huge. Taxes don't stop there. What other taxes inside the corporation do you pay?
Inside the corporation. So, well, they tax us on everything. So the next one is tax on death, right? So if you've got your investments inside of a corporation and you die, your remaining or receiving shareholders don't just get to take that out, right? Like they're going to pay that full tax. They're going to be left with 50 cent dollars when they got to pull it out. So that's huge. That death tax, you kind of forget about it, but you're, the remaining shareholders are going to feel it when they have to keep taking those funds out. They're not going to get any reprieve there. They're going to be paying their taxes as well on that death tax.
Yeah, so it sounds great. Hey, I invest in 88 cent dollars instead of 50 cent dollars. That's way better. But then it's like, well, there's going to be tax on the growth. Then there's going to be tax when you access that money and you try to get it out of your corporation to spend. So you're going to have tax on the growth, tax when you spend it, and as you mentioned, tax when you die. So there's 3 levels of taxation there after you've already paid the corporate tax of 11 or 12%. So a bunch of tax inside the corporation, and when the money leaves the corporation, if you invest those 88 cent dollars inside your corporation. So
yeah, it's not surprising we're seeing a lot of business owners just keep it in cash, right? Like you see a ton of business owners just holding on to their retained earnings because it's just not worth it. You don't want to throw that volatility in there too. You need those funds on hand. So you talk to, if you ask a lot of people, they're sitting on quite a bit of cash in their corporations because they need it and they don't want to invest it because of all of those things we just talked about. Yeah. But there is a solution, right?
So the solution is, we can do a corporate-owned infinite banking policy, high cash value life insurance policy inside the corporation. So instead of taking $1 from your corporation, paying it out to yourself in a salary or small business tax and then a dividend, either way you're going to be left with 50 cents. Instead of doing a policy personally with that 50 cents, we can do the policy right inside the corporation and put those 88 cent dollars in. So again, we add some bigger numbers to this. If we talk $100,000, well, if you want to do a plan personally, you're going to have $50,000 to put in after tax. But if you want to do that same plan corporately, you're going to have $88,000 to put into that contract. 88,000 versus 50,000. That's about a 76% increase. So this is one of the last places where business owners can really take advantage of the existing tax laws. So great opportunity for business owners. And then once it goes in the policy, Christina, what happens to the growth?
Well, at the end of the day, the product's the same product that we're using for the personal policies and we're using for the corporate policies. So all of those benefits that we love and we talk about regularly are still going to apply. So we're not going to have that tax on growth. Like there is no tax on growth. It's inside the policy. And if there's no tax on growth, it's not going to impact that passive income either, right? You're not going to see that passive income annually from it. It's all growing inside that policy, just like we would see on a personal policy. It's It's not going to impact you. That's huge. That doesn't happen anywhere else
No.
inside of a corporation. It's not possible. A lot of business owners use it just for this. They're like, my passive income, well, I put it in here. This is perfect, right? Like just one of the many things, but it's huge when you think about it, right? The fact that we don't have tax on growth inside of one of these policies.
It's amazing. You could have $10 million in there earning a 6% dividend plus, and none of that would be considered taxable income, and none of that would affect your passive income. So we see a lot of business owners that have a lot of money inside the corporation where they're pushing that $50,000 passive income thing, saying, what are the solutions? What can I do? And the solution usually is they sit in cash so they don't earn any income.
Yep.
Well, the much better solution is to fire that money into an infinite banking policy. So no tax on the growth. And then if the corporation needs money and they need to access that money, they get a loan. And how much tax do you pay on that loan?
We don't pay any tax.
We don't pay tax on the loan.
Nope.
So the growth is tax-free. When the corporation accesses it, it's tax-free. And then the big one, or the big one at the end, there's tax at death. So there's something called a capital dividend account, and we could do a whole podcast on that. So we'll just give you the big picture. But roughly speaking, that life insurance death benefit is going to flow out, either most or usually all of it. If you lived close to life expectancy, all of that death benefit is going to flow out tax free. So now, maybe you have a $2 or $3 million death benefit. That money completely flows out tax free at your death to your surviving shareholders, which ideally would be your family members. And we'll talk about that in a minute. But basically, growth is tax free. Access it tax-free, and you die, it comes out tax-free. So we've eliminated those 3 levels of taxation, which is huge. And then in retirement, there's all kinds of ways we can spend this money in retirement. We can say, okay, we've got that death benefit, so now I can leverage all my income properties, max out the loans, and not care about it because I know at death there's going to be money come in. I can access money from my house. I can use this as a volatility buffer. I talk about in the Be the Bank book what that is. There is a place too with a certain couple different banks where they will loan you that money personally, even though the policy is owned corporately. Now, again, too many details to go into today, but it's possible to get a personal loan on that corporate-owned policy. Typically, that's in retirement, so you'd have that personal loan on a tax-free basis. Again, more tax implications on that we'd have to discuss with an individual, but that's the big picture. Grow it tax-free, borrow it tax-free, die tax-free. We're eliminating not just 1, but 3 levels of taxation.
Yeah, it's a lot. We talk about tax being your number one wealth destroyer. And inside these policies, we know that there's a competitive rate of return, right? We're not talking huge returns inside of these. But if you do some comparisons, and we do this regularly, you do the comparisons, and it has nothing to do with that rate of return. Like you eliminate 3 layers of tax and your returns are massive. And it has nothing to do with the return you're getting inside the policy at all. It's just the fact that we are not paying those taxes out, right? More to you and your family than CRA, which is, we want to be doing.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Yeah, it's almost we have to caution clients when we're showing them the numbers. It's like, okay, I'm going to show you the numbers, but just keep in mind, the reason it's going to look phenomenal is because we're eliminating 3 levels of taxation for the next 50 years. And you do the math on that. I go, we're not earning a 58% return a year because people are like, how can this be so good? And it's, well, the return's competitive rate of return. But when you start being efficient and eliminating or deferring those different levels of taxation, it is a freaking game changer.
Yep.
Absolute game changer.
Lifelong tax planning too, right? Like it's important. That's what the wealthy do. You want to make sure that you're working on this now, and it's going to make huge impacts long term. We talk about it a lot, I know, but you can eliminate that wealth destroyer, you're going to be one up on the rest, right?
Okay. So what other things we need to talk about? Let's talk about OpCo versus HoldCo. That's
big
a great
question.
one. So we just talked about corporations, owning a policy in a corporation, which is a phenomenal idea. If you have corporate money, right? If you have personal money, a personal policy makes more sense. If you're sitting on retained earnings, corporate policy makes sense. I have both. I have personal policies. I have corporate policies. So they're both great. But when you start looking at a corporate policy, there's a few things you really got to be aware of. So typically, a company that is an active business corp. So active business, you're conducting business, and you qualify for that 500,000 small business tax deduction. That operating company, that company is considered an operating company. Then we have something called holding companies. And a holding company is typically a business owner will be successful and they'll have money in the operating company, or they'll have real estate or land, and they'll say, we want to set up a separate company to hold our assets. Typically land, buildings, real estate, cash value, life insurance. So in a perfect world, we want that money, we want that policy in the HoldCo. And again, we're not accountants, but roughly speaking, you can take retained earnings from your from your operating company, and you can roll them into your holding company without any tax implications. You might go through a trust first, but they'll end up in the HoldCo. So we can basically move those 88-cent dollars into the holding company. And that's ideally where we want to buy the policy, because you can start it in an operating company. And I actually did this myself. You can start a policy in an operating company. The downside of having it in the operating company is when you have a corporate-owned policy, you lose the creditor protection. So in a personally owned policy, if you have a family member as the beneficiary, you get sued or go bankrupt, they can't touch that. Inside a corporation, you can't have a family member as the beneficiary because the corporation is going to be the beneficiary. So now, if you get sued or go bankrupt, that policy is an asset of the corporation. If you have 100 grand of cash value, it's no different than if you had $100,000 in a bank account. That's an asset of the corporation. So if you ever get sued or go bankrupt, ideally you'd want it in the holding company, because money inside a holding company and money inside an operating company are two independent things. I always say it's like if you own shares in IBM and shares in Google. Well, if IBM goes bankrupt, Google's still there. Well, your OpCo, your HoldCo is the same thing. Your operating company could go bankrupt, and your HoldCo's a separate company. It's protected. So ideally, we want to move that money from the operating company over into the HoldCo. We do it there. You can start a policy in the OpCo and then slide it over if you do it in the first number of years. But that's the OpCo HoldCo. Did I miss anything?
Another little note on that. Another reason we want it in the HoldCo is because these are life insurance policies. You will have them for life, right? They're going to be around forever. So, company not going bankrupt, company being sold, let's say operating company gets sold, we do not want our policy sold with it. We want to make sure we keep that policy for life, because all of those, those long-term benefits that we're putting in place, we want to take them with us. So that is another big reason. Whatever company, operating company, holding company that you set up, you want to have that company for life. You don't want to lose it, because you want to make sure that you have that for life, right?
Yeah, exactly. Imagine going to buy an operating company and they're like, oh, yeah, by the way, we have this other asset in here of a $300,000 cash value insurance with a $2 million death benefit on the owner. And it's like, I don't want to buy that. That would be an asset of the corporation. And you get too much money in there, too. You could set off your capital gains exemption that, we'll talk another time, or talk to your accountant about. Okay, so the other question we get on these policies are, okay, I have a corporation. I own my corporation. Can I put a policy on my spouse or my kids inside that corporation, Christina?
Yeah. So, and that's a great question, because at the end of the day, these are life insurance. So there's an insured person where the death benefit pays out. I know we talk about all the other benefits, but there is that insured factor. And when we're getting these put into place, the life insurance company is going to look at the reasoning we're insuring that person. You just, you need an insurable interest. You can't just pick someone off the street and say, I'm going to insure them in my company. That's not how it works with any type of life insurance. Typically, we're looking at key people. So very easily, as the owner, you are a key person. Then we start looking at the other key people. So spouse does work as a key person, right? There's a very good chance a lot of individuals will have their holding companies and operating companies owned jointly with spouses for other reasons. So very easily, they are a key person. If they don't own shares, that's okay too. Typically, at the end of the day, they're going to inherit shares. They're going to look at that as key person. And if something happened to your spouse, you might not be able to get back to work. You're going to have to take that time off. They look at that. The insurance companies see that, and they know that your spouse is a key person just as much as you are. When it comes to the kids, that's a different ball game. You know, your kids aren't key people. Well, younger kids, you know, we're talking younger kids. They're not key people in your business. If something happened to them from an insured side of things, your business would keep running from the look of the insurance company. So we can't put children's policies inside corporations. That's not going to work. Later on, if you have an adult child that is working in the business and they are a key person and you know, they need to be there. And we see that too when you've got adult children working in businesses. That's when we can look at putting a policy in place. But you know, these younger kids policies that we talk about in our podcast where we're setting them up with their savings for life and whatnot, that is not going to be a corporate owned policy. That is going to be a personally owned policy to keep everything on side with the insurance companies and CRA.
Perfect. Thank you for that, Christina. And then, like we're talking about infinite banking or whole life policies here, but I just want to make a note too. Like, if you have term insurance, it makes sense to have your term insurance inside your corporation too, especially if you have a HoldCo. Because again, let's say your term insurance is, $50 a month or whatever, you're $100 a month. Well, if you're going to take 50 cent dollars to pay that personally, you're going to take, $2 from your corporation to net $1 to pay that premium. Versus if you're only paying the 12% tax inside your corporation, it's going to be 76% cheaper, your term insurance, to put that inside the corporation. And you die, and that money, the term insurance will just flow out tax-free to the surviving shareholders. But I want to get into the surviving shareholders. So when we set this up, for all insurance policies, there's an owner, a payer, and a beneficiary. In this case, on a corporate-owned policy, your corporation would be the owner, your corporation would be the payer, and your corporation would be the beneficiary. So in the event of death, it's really important that you talk to your lawyer and your accountant and you have your will set up properly, because what'll happen is, so let's say it's ABC Corporation. ABC Corporation, the owner dies, there's a $5 million death benefit paid to the corporation. That will be completely tax-free, but that $5 million is still in the corporation. But that's going to create something called a capital dividend account where up to $5 million, depends upon when they die, can flow out completely tax-free to the surviving shareholder. The key word there is surviving shareholder. If I have a business partner and I go, great, my partner's going to inherit the shares when I die, that's the deal we have. Well, then my partner's going to have $5 million in his company that he owns completely now, and he's going to be able, or she's going to be able to, as I look at Christina, she's going to be able to take out $5 million of money tax-free from the corporation. So you got to make sure the surviving shareholder has to be set up as the person you want the proceeds to go to. So typically it's your spouse. So you're going to want your spouse or your family as the people that are going to inherit the shares. Now they can sell them after you get the money out, but just be real careful. As sometimes we'll have two business partners saying, "Oh, we're going to buy a policy together inside our joint company," and it's like, okay, but what's going to happen at death? It may make more sense for you guys to each have a holding company, so you can leave those insurance death proceeds to your family if that's what your goal is.
Yeah, typically with business partners, you want those holdcos intact for sure to be able to kind of do that separately and have agreements put in place, get your wills updated. I always say when you're getting your corporate policy in place, make sure you double check your will to make sure that structure's all, set up properly.
Yeah, and I think, we've talked about some tax stuff and complicated stuff, and I think this just reiterates why you want to be dealing with someone who's an expert at this, someone that deals in infinite banking all the time, that does these deals every single day and knows how they're structured and has the resources, the accounting and lawyers in the background to help set that.
Yeah, and you structure these wrong, and you can get in. It's not good. Structuring these wrong is not a good thing. You want to make sure that everything's on board. You should have a specialist working on it. Your lawyer's involved, your accountant's involved, and everything's done correctly. It's very important to do it correct, because when you do it correctly, it's all going to work out exactly as we've planned it. Right.
And it amazes me, even when there's an accountant or lawyer involved, if it's an insurance advisor that's not great at this, the accountant and lawyers, sometimes this isn't what they do every day all the time, right? Depending what accountant and lawyer you use. And they're relying on the insurance agent's advice. And I've seen time and time again where I review, a new client's plan and I'm like, why is this set up this way? And it's like, oh, that's the way they told me. And I'm like, if you die, this is what's going to happen. And they're like, huh. And then literally.
It's a regular basis too.
Yeah.
Regular basis.
I called up an accountant. I'm like, it's like, oh, I didn't realize it was set up that way. And I'm like, because again, they were relying on the insurance guy. So, make sure you deal with someone that knows what we're talking about. All right, Christina. Now, we got money in here. The money's going to grow tax free. We can spend it in retirement. But what else can we use this money inside a corporate owned policy, infinite banking policy? What else can we use that money for?
Anything that we would have used previously, right? Like it's just your ultimate savings account. That's what I call it. If you've got a savings account in your corporation, this should be your savings account because you can use it for your expenses. You can use it for your opportunities, right? You have full access to that at any time. You're in control of it. You request that loan, it's in your bank account within couple days and you using it for whatever you need. It could be a business expense. It could be, an emergency investment, private lend if you want to do that afterwards, right? You literally use it for any infinite things you can use it for. Right?
Infinite things.
Infinite things.
You took my line. Yeah, like, and I'll tell you as a business owner, like, once you like fully understand this infinite banking concept and you understand that it is like you said, Christina, like a savings account on steroids with so many other bells and whistles that come along with it. Well, no business owner ever has a problem cutting a check for $50,000 or putting $50,000 into their bank account.
Yep.
Right? Because why? Well, they put it in their bank account, doesn't earn anything, just sits there and pays some fees. But they know if they need the money in 6 months or 12 months, they can access the money. Well, once you understand the infinite banking policy in your corporation is just like that, a bank account, except it's your bank, a bank account in your bank that's supercharged, it grows tax free, is all these other bells and whistles. So, I can cut a check into a corporate owned policy for 50 or 100,000 and not think twice about it because if I need to access that money 3 months for payroll or for an opportunity or for whatever, I can just borrow that money and access it right back. So if you think of it like money in, money out, now I have no reservation of doing larger policies inside my corporation because it's money in, money out. I put money in, then it's like, oh, well, in July I'm going to need that money to, make another payment on the refinance or do a reno on a property I have, or I'm going to put that money in there. But I know in 9 months, if an emergency comes up, I can access 50 grand or 100 grand or whatever I want. So, if you think of it like a supercharged bank account, it's not an expense. You're just taking your money that's sitting in one place and you're putting it in a much better place or a much better wealth bucket that's going to have way more advantages for you.
Yeah. And you're going to benefit from it for a lifetime, right? So sometimes as business owners, we do get a little bit short sighted and we're like, we got to do our business investments. We got to grow our business. And I get that. I feel the same way. But the nice part about this is in the background, your retirement plan is brewing, right? Like it's happening behind the scenes. That retirement that's happening. You're saving for your retirement. You're setting up an emergency savings plan. You're building your investments. It's all happening at the same time without you having to, think long, think short term, think long term. It's all going to do that for you in one, which is that's really big for a business owner, I think, because we do sometimes get short-sighted and want to put all of our, we want to put everything into our business, which I get. That's where we make our biggest returns. But it's nice if we can be doing both at one time, right? Having our money work in two places.
Yeah, I mean that we talk about the and asset all the time, and this is the perfect explanation of the and asset you gave, Christina. Is I love it. I'm putting a whack of money in my corporate owned policies and my personal policies. And I know my corporate owned policies are going to compound tax free for the rest of my life. And I'm going to have a beautiful retirement based upon that. And I'm going to have a death benefit that's going to pay all the taxes and all that stuff. But now I just look at and opportunities and say, okay, yeah, I'm doing that. But really, I think of it like a bank account and I've got money in the bank account. And great, I have an opportunity in 3 months to go make a bunch of money at this. Access my money, go do the deal. Access my money in 9 months to go do another deal. Access my money in 2 years to put back in the business or buy a competitor. And every time I access that money, my retirement doesn't change at all because I'm multiplying money. My money's growing tax-free in the policy and it's providing a death benefit and it's going in this other opportunity, business expense, business opportunity. So it's just an amazing way to basically the best of both worlds. It's short-term money because you can access it, but it's also saving for the long term.
Yeah. And the other one's the estate planning, right? Like for a business owner, this is the ultimate estate plan. If you've got money in your corporation on the day you die, it should be in a life insurance policy. Like there is no better place on the planet for it to be for your family and for your, to leave that legacy behind. Because this is the most tax efficient way to do it. So another and, right?
Absolutely love it. All right, so let's wrap up here. So let's talk about why you should have a corporate owned policy. And again, if you have corporate money, you should have a corporate owned policy. So we're gonna take $1 inside the corporation, and we're gonna pay tax, and we're left with 88 cents instead of 50 cents if we take it personally. We're going to take those 88 cents and we're going to put them inside an infinite banking policy, and we're going to compound them tax-free for the rest of your life to have an incredible, probably tax-free retirement or tax-efficient retirement down the road. Then we're going to take that money, we're going to multiply it, provide a death benefit for you and or for your family. So when you die, that tax-free money is going to flow out of the corporation to your family, pay off the loans, pay off the debts, pay off the taxes, keep the properties in the family, whatever you want to do. And then we're going to multiply it 10 or 20 or 30 times over the next 10, 20, 30 years. And we're going to multiply those dollars, and we're going to treat it like an and asset and take advantage of additional opportunities like private lending, like real estate, like putting it in my business, like, I don't care, Bitcoin, like when the stock market drops 36% in July. Whatever the opportunity is, you can continually take advantage of those opportunities over and over and over again. And then you get this huge death benefit. And I'll tell you, Christina, I've got lots of death benefit. And to me, that's a permission slip to say, I can leverage my income properties, get big loans on them in retirement. Who cares if I die with all kinds of life insurance death benefit? I could leverage my house. I could spend my other assets down to zero and leave my family with not a lot of money, but boom, there's a big lump sum of death benefit comes in. So it's really the ultimate business owner strategy for short-term, long-term, tax-efficient retirement. That's why a lot of the larger policies we do are corporate-owned policies. So that's the corporate-owned infinite banking policy. Yes, you should do it. You should talk to an expert. Reach out to us if you have questions. Thanks for watching. Thanks for listening. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.